Hi, everyone. This is Jason Barack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest that we had him on last year. He's an oil and energy expert. He's founder and chief analyst at the Capitalist Times and energy and income advisor. His name's Elliott Gue. He has a very impressive bio, including undergraduate and master's from the University of London. So thank you for joining us, Elliott.
Well, thanks for having me on.
Now, Elliott, we've had just pretty much carnage basically since I think June in the oil markets. Oil's down approximately 50%. Why, in your opinion, has oil fallen so much so quickly?
Well, it's primarily a supply issue this time around. In 2008 and 2009, it was more of a demand-led issue. That the demand for oil collapsed, and therefore we saw prices come down. This time around, it's really more of a supply issue, and it's really been something that's been building for years now. And there basically is that we have very rapid production growth outside of OPEC, and most of that, of course, is coming from the United States, and it's coming from a lot of these unconventional plays like the Bakken Shale of North Dakota, like the Eagle Ford Shale of southern Texas. So we have all this oil production growth from the U.S. To put it in real terms, the U.S. was producing less than 5 million barrels of oil a day in 2005. Now we're producing more than 9 million barrels of oil a day. So, we've seen tremendous production growth, and at the same time, demand's been growing. But over the last year or so, demand hasn't been growing enough to offset all this non-OPEC production growth. And what essentially happened is that the oil market's become oversupplied, meaning there's more production growth than there is demand growth. So OPEC has really been presented with a choice. The Organization for Petroleum Exporting Countries had a choice. They could cut their own production. They're producing around 30.5 million barrels of oil a day today. They could have cut that by 1.5 million barrels of oil a day and rebalanced the global oil market and kept prices higher. Or they could have just done nothing, which is basically what they decided to do in Thanksgiving, and allow oil prices to fall. And so they chose to do nothing, and I think the reason that they did that is the experience that OPEC and Saudi Arabia in particular had in the early 1980s. Now, if you go all the way back to 1980, oil prices had been rising for years throughout the 1970s, just as has been the case over the last 5 years or so. Or over the last 10 years or so. And at the same time, in the late 70s, we began to see non-OPEC production growth ramp up because high prices incentivize these companies to go out and find more oil. Back then, it was the North Sea of the UK and Norway. It was the North Slope of Alaska. It was the Cantarell oil field in Mexico. This time around, of course, it's shale. But the same thing. Non-OPEC production started to ramp up. Back in 1980, OPEC chose to keep cutting production to try to keep the price of oil up. So between 1980 and 1985, OPEC production went from 30-plus million barrels of oil a day to 15 million barrels of oil a day. And Saudi Arabian production went from 10 million barrels of oil a day to 3.1 million barrels of oil per day. It did help to keep prices up. Prices dropped in real terms between 1980 and 1985, but only about 40% or so. The drop would have been probably a lot more and a lot faster, had they not cut production. But, one of the offshoots of them keeping prices up was that it encouraged all these non-OPEC producers to continue going out there and exploring for new oil fields and producing and developing these fields like the North Slope of Alaska. So we saw non-OPEC production continue to ramp up, and OPEC's share of the market went from 55% in the late 70s all the way down to 25% in 1985. And yeah, they kept oil prices up, but Saudi Arabian production went down by 70% nearly. So, their total oil revenues collapsed. So, a lot of people earlier this year were expressing surprise at what OPEC, they felt that OPEC would cut production to balance the oil market and keep prices up. I've been saying for a while that, it looked increasingly likely that they would not do that. They really don't want to repeat the experience of 1980 to 1985, where they had to cut back production so much that their oil revenues fell so far that they weren't even able to balance their budgets internally. So, a lot of people have been saying, well, Saudi Arabia needs $95 a barrel to balance its budget, and that's true. But the reality is it's not they can't. It's not that they can't afford lower prices temporarily. It's that they can't afford to allow their production to drop so far that it lowers their overall oil revenues. So to me, it was not really a surprise at all that Saudi Arabia and OPEC decided to maintain production. And I think that the reaction in the market has been very swift because there were a lot of people leaning the other way, expecting them to continue to maintain oil prices, which of course they didn't do.
Yeah, the market reaction has been swift, and it seems like, in my opinion, an overreaction because, looking at the BP statistical review, it seemed that supply and demand were fairly imbalanced. I think BP at the beginning of the year, they did the extensive BP statistical review, and they were saying that global demand was rising faster than global supply in spite of shale. And as you correctly point out, at least based on my research, it seems that really no one outside the United States in the shale oil boom, no one meaningfully is growing global production really. So, I mean, like there was hopes that Iraq would continue to grow production, and, we had the ISIS stuff that's happened that's thrown a monkey wrench in that. There's just most of OPEC just has not been able to grow production. There's just been and now that the oil price has gone down, there's production cost problems. So you have deep water, which is basically uneconomic or close to uneconomic at these levels. The shale companies, and you could probably talk about this more, Elliott, than I know. I don't know how well these shale companies are hedged. They have enormous amounts of debt. Are we going to see a lot of bankruptcies here in the short term here, and a lot of supply come offline in 12 months or so?
Yeah, I mean that's exactly what we're seeing. I mean, the oil market, you really have a choice. I mean, OPEC, you can either have artificial price or you can have a market-based price. And what we're transitioning in this sense is from sort of an artificial price where prices are supported by OPEC to a market-based signal, and the only thing the market can really adjust to give a signal to producers is the price, right? So what's happening right now is that oil prices have to fall far enough that it prompts a lot of these shale companies to stop drilling so aggressively and to cut back on their spending and their capital spending, their CapEx, on new field development and new well drilling. And what we saw at the beginning of this year, at the beginning of 2014, was really production growth from the U.S. And that's another thing. I mean, there were some estimates out there that supply growth would be in line with roughly demand growth, but really, the U.S. has been exceeding estimates for 5-6 straight years right now, in the sense that we've been producing near the high end of analyst estimates in terms of growth. And, so that's what continued to happen. And the U.S. market was already, in my opinion, even last summer, really a tinderbox because you had maybe 1.1 to 1.5 million barrels a day of annualized production growth. And, one of the problems for the U.S. market, as I'm sure you're well aware, is that, the U.S. government prohibits the export of crude oil. So what that means is that a lot of oil gets, if you will, trapped in the U.S., and you build up these regional gluts of crude oil in places like Cushing, Oklahoma, the Permian Basin of West Texas, and the Bakken Shale area of North Dakota. And so, I think were facing a problem. And what OPEC did has really just exacerbated and accelerated it. Now, ultimately, just like every cycle for oil or for commodities, the cure for lower prices is lower prices, right? Because what's going to end up happening is, as you said, a lot of these shale companies are going to cut back on their capital spending. And the larger ones, and I'm talking about companies like EOG Resources, for example, they're in pretty good financial shape. They don't have a lot of debt. They have a fair amount of cash on their balance sheet. And you know what? They haven't actually been outspending their cash flow over the last few years. So they can actually afford to simply cut back on their drilling activity, keep spending in line with their cash flow, roughly speaking, and they're going to be okay. And in fact, they're going to be in the catbird seat in 6 or 12 months' time, because when you have a lot of these smaller companies that were very aggressively leveraged, right, and they were going out there and buying up all this acreage at sky-high prices in the Bakken Shale, those guys aren't going to be able to borrow a dime. I mean, we're already hearing from some of the companies that their credit lines from the banks are going to be cut next year. So these guys aren't going to be able to continue spending as they have, and some of them are going to end up bankrupt. Others are going to end up, sold off at fire sale prices. And ultimately, the big beneficiaries of that are going to be, your big, well-capitalized producers like EOG, who are going to be able to go in there and acquire this acreage or acquire these companies, for a pittance. The question is, how long is that going to take? I tend to think that it's going to take 6 to 12 months for that all to work out. And in the commodity markets, I got to warn people, commodity prices have a long-standing tendency of overshooting fair value. So if the fair value for oil is probably $60 a barrel, let's say, that probably means that oil has to go to 40 to get down low enough to really, really make sure that a lot of these producers bring production offline. And I think that you're going to see some pain over the next 6 months, 12 months. But the ultimate, as you mentioned, the ultimate, resolution of this will be a supply and demand response. On the supply side, cutbacks in production. On the demand side, we're already seeing demand for oil, for gasoline in the U.S. ramp up because prices are lower. You saw the numbers for SUV sales in November. They were some of the strongest they've been in years. And that's because, prices are coming down. It is incentivizing new demand for oil. It just takes time for this to work through the system and result in, support for prices.
Good, great points, Elliott. And also, China has started stockpiling enormous amounts of oil. They're just locking in, long-term oil and moving it with tankers over to China, stockpiling it. And, in terms of you're saying further pain, I mean, this is tax law selling season. So I interviewed 5 or 6 other energy experts and oil experts besides yourself the last couple weeks for our listeners, because I think there is incredible opportunities in the oil market if you do your homework right now for the next 6 months or so. I think it's probably as good as 2009, right when the shale boom was just getting started back then. So I think there's enormous opportunities here if people do their homework. Now, obviously, everything is not a buy. So people are going to have to be very careful. I think the most important thing you mentioned there was debt. The debt was just so easy and so cheap, whether the Federal Reserve's doing whatever policy or the banks got, addicted to shale boom fever, and they just gave out loans because the oil price was either pretty high or keep on going up. And you see what happens in the commodity markets when debt has to be paid back at a fixed cost and the commodity price drops. Their cash flows go like crazy unless you're properly hedged. And I think there's very few shale oil producers. I think most of them are only hedged, 40% of their production, maybe 12 to 18 months worth of their production is hedged, if that. So they weren't expecting this correction, and many of them are going to pay for it very dearly.
Yeah, sure. I mean, you really have to be. There's going to be big winners and big losers from this, as we've been saying. But I mean, I think what you have to start doing now. This is a very good time to do it, actually. Sift through those exploration and production companies. Look for names with low debt, solid acreage positions in some of the main shale basins, like the Permian Basin of West Texas, the Bakken Shale of North Dakota, the Eagle Ford Shale. Companies with low debt, solid acreage positions in those areas. They're the ones that are going to benefit when oil prices do bottom out, which I still think could be sometime in the future. But when that does happen, these guys are going to be the ones that are going to be out there, picking up a lot of these weaker players for a pittance. And, I would say names like EOG Resources, Occidental Petroleum, Concho Resources. These are names that are going to be able to be out there with the cash to purchase things at deeply discounted prices. I mean, think back to, how really easy it was for people with cash to make money back in 2008 and 2009. Guys like Warren Buffett were able to go out there and buy assets at deep discounts because everybody was desperate for cash. You're going to see the same thing in the oil market. To me, it's on those producers, it's really just a question of when. I agree with you that we've seen some tax loss selling, a lot of tax loss selling. I see it with people I talk to as well. And I think that you probably will see oil bounce in the very short term, probably into early 2015. We've moved down just too far too fast. However, I do think you will see a renewed weakness at some point early in the new year. But again, that'll be sort of the last leg of this bear market. And, that's where you're going to have a great opportunity, in my view, to buy names like EOG, Occidental, Concho, et cetera.
Now, if the oil price does go low enough, now you mentioned the Saudis can survive, but what about these other OPEC countries who don't have as much cash in reserve, kind of like Venezuela, Nigeria, Iran, Iraq, where they're just basically they're paying their bills day to day with their oil. So the majority of their budget is, or Russia even, where they have so much of their oil and gas, they're not necessarily hedged. What do you think is going to happen to in Mexico? What do you think is going to happen to some of these other? Is there potential Arab Springs there or civil unrest?
Well, I mean, your countries that are probably in the worst shape are going to be countries like Venezuela. Venezuela was in sorry shape long before this whole thing started. The government there, is pretty much incompetent, I think it's fair to say.
Marxist too, yeah.
Yeah, absolutely. So, I mean, they needed $140 a barrel oil to balance their budget. Well, that's not going to happen anytime soon, I can tell you that. So, and then you've got countries like Nigeria, which have budgetary issues at current prices as well. Your Gulf oil states, your big Gulf states like Saudi Arabia, Kuwait, United Arab Emirates, etc. They're going to be okay with prices down here. Yeah, it's going to be a problem for Iran as well. And I think that where you have the most potential for Arab Spring type unrest would be a country like Saudi Arabia, right? Which, if you were to have an Arab Spring there, it would be an absolute disaster because it's the most important producer in OPEC. It's the only country in the world with real spare capacity. However, I still think that's very unlikely because Saudi Arabia has plenty of cash to run a deficit for, plenty of reserves to run a deficit for even 2 years or so, and continue to keep up their social spending, which if you remember back in the Arab Spring, the way the Saudis stopped it from spreading to Saudi Arabia was to go out and spend a ton of money on housing projects and a bunch of other social spending. And they can maintain that even with much lower oil prices for a time. So it's going to continue to be a problem for countries like Venezuela and Nigeria. And you got to remember that that's part of the point of this. One of the reasons that Saudi Arabia, Kuwait, UAE, etc., have been fine with oil prices dropping is not only are they targeting the U.S. shale producers. I mean, that may be part of it. But a big part of it is also they're targeting other members of OPEC. Because remember, Venezuela has been pretty much refusing to cooperate with any efforts over the last few years to change its oil output to meet the goals of OPEC, right? Same with Nigeria. These guys have been producing pretty much flat out and allowing Saudi Arabia to lower its production to try to keep prices up. So Saudi Arabia has been doing all the work, and they've been reaping most of the benefits, which, of course, is the fundamental problem with any cartel. So part of this is about Saudi Arabia just sort of slapping these guys on the wrist as well and making them feel a bit of pain so that they'll be more cooperative in future. So I don't think that unrest in those really high-cost production countries is going to be an issue which disrupts the flow of oil over the next 6 months or 8 months. A lot of those countries cannot afford to cut back on their production because, frankly, even at lower oil prices, it's really their only source of cash. So I don't think you're going to see these guys cut production until maybe 6 months from now when they're in next June when the next meeting is, when they're in so much pain, and then I think you're going to see them be more cooperative with Saudi Arabia, and of course that's going to be another thing that helps oil prices bottom out.
That's interesting. Do you think then that there's good opportunities then in the MLP sector right now in the midstream?
Yeah, I do. I think that that's really the best opportunities right now. I mean, the thing is that when oil prices come down, when commodity prices come down, when energy stocks come down as fast as they have over the last 6 months or so, everything with energy in the name or power in the name or anything that's remotely connected to the energy sector is going to get pummeled. You're going to get this sympathy sell-off. And that means that good stocks are going to get pummeled and bad stocks are going to get pummeled. And so, really one of the things that I like to look at is, what companies are out there that, are trading down from where they were maybe, but don't deserve to be. And there are a lot of names out there that fit that category. Some of my favorites right now are companies or MLPs which have a strong what we call drop-down growth angle. Now, I'm sure your listeners are familiar with MLPs, but MLPs are a combination of two entities. You have a general partner, which is kind of the manager of the MLP. They make the decisions like, shall we make this acquisition? Shall we build this pipeline? And then you have the limited partners, which is basically you and me when we buy the MLP. And we're entitled to cash flows from the MLP in the form of distributions, but not management decisions. So one of the trends we've seen over the last few years is that big companies are sponsoring MLPs. So a big energy company will create an MLP, and then they sell assets into that MLP. Now, why do they do that? Well, it's simply tax advantages. The MLP is not taxed at the corporate level. Assets like pipelines throw off a ton of cash. And, the U.S. has the highest corporate tax rates in the world. So, sheltering from that corporate tax rate is not in the world, but in the developed world. And, sheltering from that corporate tax rate is very desirable. So, one example of this is Shell. I'm sure you've heard of Shell, Royal Dutch Shell, one of the biggest energy companies in the world. They created an MLP called Shell Midstream. The symbol is SHLX. Just went public. Shell owns tons of midstream energy assets in the U.S. Now, these are pipelines, oil and gas storage terminals, things of that nature. Very low-risk, commodity-insensitive businesses. A pipeline owner does not care whether the oil running through their pipeline is trading for $50 a barrel or $150 a barrel. All they care is that there's some volume moving through that pipeline. Typically, pipelines are basically contracted under 10 or 15 or 20-year deals. And what these deals are is that they include what's called a capacity reservation charge. So the pipeline owner says, all right, I have a pipeline with 500,000 barrels a day of capacity. I will reserve 100,000 barrels a day of capacity for you if you pay me whether you use the pipeline or not. So it's kind of like a minimum fee, very, very safe, very secure business model. Shell Midstream, when it was created just a couple of months ago, it started out with some very important assets. One of them is the Zydeco pipeline, which connects, better known as the Ho-Ho pipeline, which connects Houston, Texas to Houma, Louisiana, hence the term Ho-Ho. Very important, fully contracted pipeline, which takes light oil from the Houston area to Louisiana where it can be refined. Another thing that they own part of is the Colonial pipeline, a refined products pipeline that supplies almost half of the East Coast's gasoline demand. So absolutely crucial asset, fully contracted, always being utilized. So these are very safe assets that are in Shell Midstream. In addition, Shell still owns some assets at the corporate level that it plans to drop down to this MLP over time. Every time it does one of these drop-down sales, it tends to increase the distribution for Shell Midstream holders. So right now you have an MLP that's yielding about 2%, so a little on the low side there. But I think that they'll probably be able to grow that payout at a 15 or even 20% annualized pace over the next few years. And it doesn't really matter where interest rates go. It doesn't really matter where oil prices go, where natural gas prices go. This thing is still going to be able to increase its distributions because it's backed by one of the largest and most financially stable energy companies in the world that's absolutely enormous in the form of Royal Dutch Shell. Yet, will it get hit when oil prices go down? Yes, it will, because it has, the term energy in the name. So, that's an example of a company that I think it's a baby that's been thrown out with the bathwater.
So this sounds like a Warren Buffett type of value stock where you should maybe invest for cash flows where you can get a solid income stream from, where they can potentially grow the distribution rather than necessarily capital gains. And if you get capital gains in a couple of years, it's just a bonus. It's just gravy on top. That's what it seems like with these types of investments. But
exactly. Exactly.
Yeah.
I mean, what's tended to happen over time, just real briefly, is that MLPs that grow their distributions over time. So let's say an MLP grows its distribution every year at about 10 or 12%. Historically, on average, that MLP, the value of that MLP in the broader market can be expected to go up about 10 to 12% a year. I mean, obviously, there's a lot of volatility around that, but if you're looking at it from that perspective, you're going to get that immediate yield, and as growth in that yield happens over time, you're going to also get rewarded probably in the form of capital gains. Although you're absolutely right, you should be buying it for cash flow now, and especially taking advantage of any dip. And you will probably have the gravy of capital gains to enjoy, a year or two from now.
Now, Elliott, some of the larger midstream MLP companies, Kinder Morgan, well, they're not, I guess they moved to a C corp now to save money on taxes. But them, Enterprise Products Partners, Plains All America, these guys have a lot of pipelines. They're going through Shale. So you're saying then that they've already borrowed, I guess, for 30 years. They've locked in a low interest rate. They already have a certain amount of take-or-pay contracts, I guess, long term. You're saying their cash flows then are not going to be that affected then if the Shale, the oil price goes lower and shale producers cut off some production?
Yeah, most of them won't see much of an impact, or certainly not enough of an impact to affect their ability to maintain or even grow their distributions. There's certainly exceptions to that rule in MLP land. One example of an area that we're recommending avoiding right now is the upstream MLPs. These would be names like Lynn Energy, Vanguard Natural Resources, Memorial Production Partners, Midcon Energy Partners. These are MLPs, or limited liability companies, which is a very similar structure. But they're actually involved not in the midstream business of owning pipelines and gathering systems and assets of that nature. They're actually involved in oil and gas production. Now, offsetting that, most of them do have a lot more hedges than your average exploration and production company. So, like a company like EOG doesn't have that many oil hedges for 2015, but, a company like Lynn Energy does have quite a bit of hedging for next year. But, hedges eventually do run out. They also have the problem, which is a little esoteric, but they've done some hedging using collars, which is an options hedge, which basically doesn't fully protect you on the downside when oil prices drop very far, very fast, which is exactly what we've seen. So, some of those names, Lynn Energy, for example, could be at risk of a significant distribution cut in 2015. Others, like Memorial Production Partners, I think ultimately will be able to hold on to their distribution. But that would be an example of an MLP area that is sensitive to commodity prices and therefore, is not necessarily unaffected by this. But your big pipeline names, like you mentioned, your Plains All Americans, your Kinders, your Enterprise Products Partners, those guys really should not see much of an impact from this. In fact, as you mentioned, a lot of these guys have taken advantage of low interest rate environment to lock in their financing for years and years. Enterprise has some 50-year bonds out there. Actually, I think 60-year bonds now, which are yielding, less than 5%. I wish I could borrow $1 billion for 60 years at 5%.
The Fed's going to inflate it away.
right, exactly. So, to me, it's just, they've done a very good job in recent years of locking in a lot of the financing at very low rates. And I think that, they may see a little bit of a hit in the sense that, a lot of times they finance acquisitions by issuing units or shares of stock. So if the price comes down because energy prices come down, it could raise their cost of capital a little bit, but I don't think it's going to be something that's going to cause them to cut their distributions and probably not really affect their ability to raise distributions. So for the most part, those big names are safe. Some of the smaller upstream names I'd be worried about.
Now, we've also seen, Valero, we've seen other companies start to create more MLPs. Is that because the valuations on these things have been higher because most investors out there have been looking for income to replace, either their job or whatever income has been lost then?
Well, yeah, that's a big part of it. There are a couple reasons why a few reasons why these companies might do it. One reason is to shelter those assets from corporate taxation, which I talked about in the case of Shell. These are highly cash-generative assets, so keeping them away from the tax man is desirable. The second thing is that developing shale not only requires a lot of drilling activity, a lot of investment in drilling, but it also requires a lot of investment in infrastructure, right? So I mean, it doesn't do you any good to produce a ton of oil if you don't have a pipeline or some sort of a rail terminal to actually take that to someplace where it can be refined. So, I mean, investors have been very attracted to this space because they offer high yields. And so they've been able to create these vehicles and use these vehicles to raise capital to fund the creation of all these midstream assets. So that's been just supporting the growth of shale, which, again, I do think that you're going to see a hit in the near term in terms of production and drilling activity and everything else. But, if I'm looking out 10 years from now, the U.S. is going to be producing a lot more oil 10 years from now than we're producing today, right? The U.S. is going to be a far more energy independent place 10 years from now than it is today. So you're going to see these hiccups in growth. And, in fact, I think this one is in some ways healthy for the industry because debt was getting extreme in some cases. But you're going to see this stuff developed. And some of the estimates are showing that, over the next 20 years that we're going to need $1 trillion of energy midstream investment just to keep pace with this development. So, that's a major reason that these things have been listed. And like you said, I mean, in 2012, there was a fascinating chart I saw. I think Merrill Lynch created it maybe a couple years ago. They came out with this report. And they actually tracked bond yields in Holland, in the Netherlands, going back to 1540, okay? And in 2012, bond yields in the Netherlands hit the lowest they've ever been since 1540. So, I mean, talk about a yield recession. Yeah, of course, individual investors, especially, in a country like the U.S. where there are more people getting close to retirement, they're looking for some sort of yield, and they're certainly not getting it out of U.S. Treasury bonds. They're not getting it out of government bonds from any developed country. So, there's been a huge yield depression, really. And so MLPs are one of the few areas you can go and still get a 4 or 5 or 6% yield that's very safe and also have the potential for growth.
Yeah, that yield depression you mentioned, Elliott, it's intentional policy designed by central bankers at the Federal Reserve in Japan, Bank of England, ECB. It's called financial repression. There's a whole bunch of white papers out on it, where they lower the interest rates down to save the banking system and allow the governments to continue to borrow. It's just punishing savers out there. It's really unfortunate.
Right.
Long term.
Yeah, I think a lot of people focus on the stimulus from lower interest rates, but when you're saving money, right, lower interest rates are actually very harmful to you because it forces you further out on the risk curve. In other words, in 2000, you could get a CD, right, with your local bank that would yield 5.5%, 6%, right? And today, the only way to get 5.5% and 6% is to buy something which has a lot more volatility and a lot more risk.
Exactly, and that's why people were buying junk bonds. They were chasing, some of the shale oil debt that was out there, and it wasn't compensating them properly for the risk. They were buying junk bonds from other companies. They were being sold, by their stockbroker or registered investment advisor junk bond funds.
Sure, yeah, absolutely. And, that brings to another point. That's another area that I would look at. I agree with you right now that, a lot of these things are vulnerable in terms of the junk bonds issued by a lot of these upstream names. But watch that space carefully as oil prices come to a low. Back in 2008 and 2009, one of the first places in energy to really recover was those junk bonds. So companies that are survivors, right, but have a little bit too much debt, when they do pull through this, I think you're going to be able to see some tremendous gains and high yields in their junk bonds. A little early for that story in most cases now, but that's something that we're watching really carefully.
Yeah, so you think then that'll be an indicator then that the market is bottom when the junk bond prices start to firm up or go higher then? Okay.
Yeah, that's one thing, and I think also I know I'm digressing a little bit here, but I think that also one thing is that again, the baby's getting thrown out with the bathwater. I mean, you have junk companies, really junk companies out there with tons of debt, and their bonds may be yielding 15, 20%, and they probably are going to go bankrupt or default on that, right? That you have other companies that aren't junk companies, they're quality companies, but they're getting caught up in the same cycle, and their bonds have gone from trading at 100, 105, or 100% or par value or a little over par down to trading at 70 or 80, right? and cents on the dollar, that might be an opportunity, right? So, you look at a name like, and ironically, if you look at some of these upstream MLPs that I mentioned a little while ago, yeah, they're vulnerable, and I think some of them are going to cut their payout. But ironically, when they cut their payout, right, that frees up more cash they can use to repay their debt. So I think you'll see some companies like Vanguard Natural Resources, for example. Right now, we don't recommend their stock, but we do like their bonds, which mature in 2020, offering, I think, about a 14% yield right now. And, they're trading at 70 cents on the dollar or so. So that might be an interesting way to play it. And I think you're going to see more opportunities there. Again, you have to be very selective, though.
Yeah, I agree. You have to be very selective, and that's a good point about the upstream guys. The upstream guys, I mean, they survived worse than this, and many of them in 2009, right? Lynn Energy, many thought Lynn Energy would collapse when the natural gas price collapsed in 2009 and the oil price 2007 and the oil price collapsed, and Lynn Energy actually came out of it pretty good. So we'll have to see what happens with the upstream guys, but I mean, they've been through this with bad cycles before. They have pretty experienced management teams.
Yeah, they have, the bigger ones have quality management teams. I do think some of them will have to cut a little bit, but that'll ultimately be pretty healthy for them, and it will allow them to survive the next year or so, and then they could really thrive in the next upcycle. And there will be a next upcycle. I think this long run up we've had in energy prices convinced a lot of people that the energy market's not cyclical, but the energy market is cyclical, right? And when you have a super cycle, as we've had over the last 10 years, it doesn't mean that you don't have down cycles. It just means that the up cycles are very powerful and the down cycles are relatively short-lived and violent, but not, as long-lasting or powerful as the up cycles. So we're really seeing a temporary correction in a much longer-term uptrend, in my view.
Yeah, I agree with that too. The oil price had been for a number of years, really, since 2010. It had been in a pretty wide trading range from about 75 to about 120, and there was a strong support for it when the WTI price got 75, because that was around the shale oil producers' all-in cost,
right.
$75 or $80 a barrel. It seems to me, though, long term, now that the capex has already been cut, I think over $150 billion out of that enormous number that you said earlier. I think there's $700 billion, over $700 billion alone that was supposed to be spent on oil capex this in 2015. That's being cut $150 billion, so that's a big cut. It might even be cut more than that. I mean, long term, a couple of years out at least, that means higher prices for the market.
Yeah, it does, absolutely. I mean, what you got to remember is that trading range you're talking about, you're right. The low end of that range is probably 70, 75 is probably the all-in cost for the shale companies on average. But also pay attention to the upper band of that trading range. What was that $115, $125 a barrel area? That's the price that oil needs to be at to incentivize some of these higher cost sources of oil output, right? So some of the higher cost sources of oil output out there, the oil sands in Canada, and something that I think is very important is deep water, right? If you look at a company like Seadrill, and this is a stock that I've been telling people to sell now for over a year, because what actually happened with them is that we began to see a slowdown in deep water capex over a year ago, in the summer and early fall of 2013. And that was when oil prices were still over $100 a barrel. Mm-hmm. So if they can't make money, or if they can't make enough money, they can make money. But if they can't make enough money on $1 billion or $2 billion or $3 billion deep water development at $110 a barrel, they sure aren't making money at 60. So I think what's going to end up having to happen is you're going to see sometimes oil prices shift so much because they're constantly going from the floor, which is the marginal cost of production for shale, and the ceiling, which is the cost it needs to be at to incentivize production from some of these higher cost plays like deep water. So, yeah, you're right. Longer term, you're probably going to have to see oil prices at $125 a barrel to get these guys out there spending in the deep water again.
Yeah, and to your credit, Ellie, I think you were the only analyst I follow who actually said that Seadrill would completely eliminate its dividend. Almost every other research report I read, and I read a lot of them, said that Seadrill may only partially cut it, and, Seadrill just completely cut it. But, so I really don't see a scenario going forward because the U.S. really has the best shale acreage the most infrastructure, the easiest access to water for shale and other expertise. I don't see any other way the world can really grow oil production globally without deep water and things like that. So in the long term, I think like this is going to be very important for deep water development and other sources of oil.
Yeah, absolutely. I mean, it's definitely going to be important, and I think you'll see a return to the deep water in probably a year or two. But oil prices will have to go back up for that to happen. I mean, ultimately, the world needs that production. Right now, the world market's oversupplied, maybe 2 million barrels a day, 2.5 million barrels a day, but that's not the case longer term. And I think it's important to remember that, although I made that comparison earlier on with the world in 1985, there's a very crucial difference, which is that in 1985, OPEC had 17 million barrels a day of spare capacity. I mean, this was production that they could bring online quickly and maintain for a period of 90 days or whatever. They had 17 million barrels a day just within OPEC of spare capacity, and it was only a 65 million barrel a day or so oil market. Today, we have a 93 million barrel a day oil market, and at best, OPEC has 4 or so million barrels a day of spare capacity. So, from a long-term perspective, the oil market's a lot tighter today than it was the last time there was a major bear market in energy in the mid-'80s.
It's very interesting, and I just want to thank you again for your time, Elliott. You provided really great insights for our listeners out there. I've been telling them I think there's great opportunity in the oil market if people do their research. They have to be discriminate, though. They have to do their homework because not all the companies there may survive, especially if the oil prices go to levels that you say if they have too much data or their production costs are too high, the company could be in trouble then.
I would agree with that. There's definitely a lot of opportunity. You might want to play it safe for the short term, but I do think there's a lot of opportunity, especially in these names, these MLPs that are kind of getting thrown out with the general energy sell-off.
Okay, well, I want to thank you again for your time, Elliott. Please tell our listeners where they can find your articles and your newsletter.
Sure. Well, my newsletter is called Energy and Income Advisor, and the website is energyandincomeadvisor.com. We have a lot of free content up there. We have a weekly free email that we send out on the energy markets. You can also find some of my work on capitalisttimes.com. There we also have another free newsletter that we send out every week that you can sign up for. We do include some stock picks in those free emails. Also just some general analysis of trends going on in the energy markets. And issues like what OPEC was going to do. It's something we were really talking about a lot just a couple of months ago in those free emails that we send out. So check us out there, and if you have any questions, feel free to drop me an email. My email address is on the site.
Okay, great. Thanks again for your time, and I'll definitely want to have you back on again soon. Hopefully the oil price will be higher, and we could talk about how you're right.
Oh, thank you very much. Thanks for having me on.